Are you ready to dissect a masterclass in market dominance? Let's dive straight into the investment deep dive for Astral Limited's fourth quarter financial breakdown for fiscal year 2026. We are going to unpack how they generated an incredible 24% growth, expanded their operational margins, and built a bulletproof zero-debt moat to achieve a true earnings teardown.
Today, we are unpacking four major areas to see what is driving this business. First, we will look at the blockbuster fourth quarter numbers, followed by a segment deep dive comparing pipes versus paints. Then, we will look at their asset-light cash moat. And finally, we will wrap up with the valuation, risks, and final verdict.
Let's look at the fourth quarter numbers at a glance. Revenue reached 2,088.5 crore rupees, showing a 24.2% year-on-year growth. Profit after tax came in at 213 crore rupees, an increase of 19.6%, while EBITDA scaled up to 400.2 crore rupees, marking a 28.8% surge. This pushed the EBITDA margin to 19.16%, a 71 basis points expansion. The big story here is how record volume growth entirely crushed the broader market decline, paired with expanding operational margins.
Diving into this top-line surge and margin expansion graph, we see broad-based growth that completely smashed industry trends. While the broader PVC demand dropped by 10% across the industry, Astral grew its volumes by an incredible 24.2%. This margin expansion, highlighted by that 71 basis points jump in the fourth quarter, was driven by raw material stability and immense operating leverage. Furthermore, polymer pricing stabilized rapidly, paving the way for a solid realization recovery that directly boosted bottom-line profitability.
Now let's talk about plumbing, which remains the company's unstoppable core. This segment alone brought in a massive revenue of 1,534.40 crore rupees on a volume of 84,041 metric tons. That represents a 24.2% year-on-year revenue growth and a 25.1% year-on-year volume growth. The EBITDA margin sits at an industry-leading absolute margin of 22.94%, driven by production optimization and the rapid scaling of their new Kanpur facility to grab market share from unorganized players. This brings us to a fascinating tale of two segments: plumbing, the engine, versus paints and adhesives, the growth bet. Plumbing shows mature market dominance with 25% top-line growth and a high, stable margin profile of 22.94%. On the flip side, paints and adhesives represents a heavy investment phase with 21.9% top-line growth, but a lower margin profile of 8.71%, acting as a near-term drag. Astral is spending 16 crore rupees on the Ranbir Kapoor Bondtite launch, effectively using the immense cash flow of plumbing to aggressively fund the brand-building phase of paints. This aggressive strategy is completely backed by a bulletproof balance sheet. The company is incredibly cash-rich, with cash equivalents ballooning to 871.90 crore rupees, up from 581.10 crore rupees. Visualize like a heavily tilted seesaw. The company's massive cash pile completely outweighs its minimal debt. Under a strict debt-free framework, long-term borrowings fell to just 61.90 crore rupees, bringing their debt-to-equity ratio down to a negligible 0.015 times. This leaves a net cash surplus of 808.70 crore rupees, meaning zero structural leverage risk. On top of that, we see superior earnings quality. Are the profits turning into real cash? Yes. While standalone profit after tax sits at 611 crore rupees, the cash flow from operations is a massive 1,084.30 crore rupees. That results in a stellar 1.77 times cash flow from operations to profit after tax ratio. Clean collection dynamics mean their recorded profits equal real, hard cash in the bank. This incredible financial efficiency is driven by an ultra-lean 24-day cash cycle. Looking at the working capital cycle breakdown, Inventory has been optimized down to just 60 days, while receivables dropped from 24 days down to just 21 days. This asset-light framework ensures that capital isn't trapped in warehouses or unpaid invoices, maintaining a standalone current ratio securely at 1.78 times.
So what are they doing with all that cash? Let's look at their capital allocation strategy for that 1,084 crore rupees of cash from operations. First, they generated 755.90 crore rupees in free cash flow entirely after capital expenditures. Out of the total deployed cash, 328.40 crore rupees went into reinvestment via standalone capex for future capacity. Another 109.50 crore rupees was used for strategic acquisitions to execute subsidiary buyouts, and 100.70 crore rupees went back to shareholder returns via dividend payouts.
What are the major catalysts justifying their premium multiple? First is their captive cpvc plant. Phase 1 of a 40,000 metric ton plant via Nexalon Chem is underway, which will make them the only domestic pipe builder making its own raw cpvc resin to boost margins from fiscal year 2028. Second is decentralized logistics, with the Kanpur facility scaling up rapidly to slash logistics turnaround costs across northern and central India. Third is consumer pull, transitioning Bondtite from a B2B product into a heavily marketed B2C consumer brand. However, there are critical risk factors to watch. Commodity volatility is key, as PVC and cpvc polymer prices remain highly sensitive to international supply chain and shipping disruptions. There is also execution risk in paints, where massive brand investments must translate into base operational volume soon to clear negative operating leverage. Finally, there is valuation danger. Trading at historically premium multiples means there is absolutely zero room for execution errors. Even with those risks, justifying the premium makes total sense. Astral trades at a historic premium to its peers because delivering a 24.2% operational volume growth in a down market validates continuous market share gains. They are, without a doubt, the undisputed highest absolute EBITDA margin operator in the pipes category.
Running through the fundamental checklist, it is a clean sweep of green signals. Earnings quality gets a green signal because cash flow from operations is 1.77 times profit after tax. Quality of growth gets a green signal through pure organic volume expansion. Working capital gets a green signal as it is compressed to 24 days. And capital allocation gets a green signal with aggressive capacity capex fully funded by internal cash. All structural indicators point to a highly optimized, dominant market player.
What's your take on Astral? Will their aggressive, high-spend push into paints pay off? Or is it a drag on the core business? Let us know in the comments below. If you found this Astral earnings deep dive helpful, don't forget to like, save, and share this video. Follow and subscribe to ZinvestZ for more smart investing insights. Thanks for tuning in.